Hello, welcome to Ask the Planman. Everything you want to know about insurance, finance, and more, but we're afraid to ask. I'm your host, Bruce Weinstein. And joining me again today for part 2 of our conversation of what Wall Street doesn't want you to know is investment manager John Browning with Guardian Rock Wealth Management. John, welcome back to the show.
Hey, thanks for having me. I always enjoy our conversations.
Let's start out with our disclaimer because we tend to do it like halfway through. So listen, folks, we're not here to give you direct individual advice on this show. We're having conversation. We're going to be using examples and scenarios of our 65 years combined history on Wall Street. Mine is a financial advisor and asset allocation manager. John is a portfolio manager in his early years and now is also an asset allocation and professional manager of clients' assets. And so we're going to talk in an abstract fashion about market conditions and the do's and don'ts and share some anecdotes of our histories that are cautionary tales. Last week's episode, we were talking about how Wall Street treats the retail client, which is John Q. Public, as nothing more than a distribution channel and to get rid of their stuff or maximize their profitability. We also touched on the catching a falling knife, meaning when the markets are dropping, you don't necessarily want to step in prematurely. And so today we're going to pick up on that conversation. We're going to do a deeper dive into maybe some asset allocation issues. We want to talk about the dead cat bounce, how you can't time the market. And so I know there was an anecdote or dote you wanted to get in last time, so let's see if we can throw those out to get the conversation going today.
Well, kind of just picking up on last time, Bruce, where we were talking about catching that falling knife. I mean, anyone who follows the Building Your Life, Not a Portfolio information that I put out there on my podcast or any of my written work, folks know that I'm a big innovation and investing in you and how important it is to be up on and understand the latest innovation and how to invest in it properly. And what we've seen over, say, the past 12 to 18 months is that idea of innovation and investing has been a very bad idea. And what I saw on, it was actually on LinkedIn, and somebody had posted a graph of Warren Buffett, and the graph was kind of going a little bit like this. And then they had published a graph of what Kathy Wood, who runs the ARC exchange traded funds, and she's very much into innovation investing, and it shows hers going way up and then dropping way down kind of like this and coming back, and they said, see, Warren Buffett is a better way to invest. And both are brilliant fund managers, okay? There's just no question about it. But what this person did not show was, what if you had done proper asset allocation? So you've got the innovation and the tech and all that's going up like this, but you didn't see that the proper allocation was to shave some off the top and put it into a more Warren Buffett-ish type of portfolio all along the way while you were going up. And guess what that would have done? That would have put a line right through the middle. And you would have arguably over time done better than both styles of investing.
So what you're basically talking about is, we threw this around last time, is getting in is easy, getting out is hard, and knowing when to get out ideally is never going to be successful, timing the market. And so what you and I talk about and what you're describing here is shaving your profits over time, having a discipline, whether it's a certain rate of performance or a certain percentage of your portfolio increase or just every 90 days, 180 days, every January 1st. And so for the theory of asset allocation is, if you look at the charts and the histories of all the different sectors of the market, they never run all at the same time. There's value stocks and there's growth stocks. There's international, there's small cap, there's mid cap, there's emerging markets. And so when you look back at these quilt charts, as they're now referred to, you can see the patterns that large cap values doing this and small cap values doing that. And, Warren Buffett's a value investor and your Kathy lady sounds like she's a growth investor. And they both have certain rates of historical performance, but they don't necessarily always interact at the same time or with the same robustness. And so when you have your tech stocks blowing up in a good way, right, melting up, not melting down, the question is, when do you hit the stop button? When do you say, my Apple just went up 28-fold in the last 10 years? Do I want to keep riding that bus, or should I take some of that 28 times my money and now look at oil 18 months ago, 2 years ago, when COVID was in its throes and nobody was going out and they were giving oil away? You could have been paid to take oil that one particular week, which was insanity. I'm like, how do I get my hands on 1 billion barrels of oil? Because they're going to pay me $32 billion to take it. I'm like, what's wrong with this picture? I had to fill up every pool. I had to fill up every swimming pool in South Florida. So that's a timing mechanism. But as you're saying, is the discipline is, this is the way I used to describe it. If 50% of your money is on one side and 50% is on the other side, and I use that, and we talk about that in the seminar, is what speed, when you're on the highway, what speed do you need to drive? If the speed limit's 65, do you go 65? Do you go 55? Do you go 75? Everybody has to make their own choice. If you go 75 and 85, you risk getting a ticket, right? Which is going to cost you money, going to cost you time, is going to delay you. If you're going 45 and a 65, everybody's going to be honking their horn, and you're the guy, driving, can't even see over the steering wheel. So in your journey with your financial plan is you have to figure out what rate of speed your portfolio needs to do to get you where you want to be, which correlates to your rate of return, which then correlates for John to pick your asset allocation correlated to that rate of speed, meaning your risk. If you're a low-risk 80-year-old investor, you shouldn't be buying all those crazy tech stocks with no dividends. True? So if we use the example, and I know not everybody's going to see my hands, they're not on the YouTube podcast, but if half is in value and half is in stock, and in your example with, what was her name? Nancy?
With ARK Invest, Kathy Wood. Yeah.
Kathy. So Kathy's stuff is up 50%, and Warren Buffett's stuff is up 10%. They were both 50-50 going in because that was the risk we wanted. She made a 50% return. He made a 10% return. Are they now a 50-50 mix in my portfolio? No, they are not. The discipline would say every year I need to go back to 50-50. Not I'm now 60-40, maybe I'm even 70-30. And so now you reposition. I'm selling some of hers. I'm buying more of Warren's. I'm repositioning it. And now I'm back to 50-50. I've hit, and again, in my seminar, I hit the cruise control. I had to pass the truck to get out of the way. He cut me off. I have to pass him in the fast lane. I'm going 90 to get past him. I have to go back to my cruise control, get back to my 70 miles an hour so I don't get a ticket. So it's okay for a while to have your stocks doing better over here on her side, but eventually you got to bring them back in alignment. Well, guess what? Next year what happens? Well, Warren Buffett's stuff is doing better and hers is retrenching. She lost 20%. He made 20%. Are they now in balance anymore, John? No. We got to go back to 50-50. Okay? So that's the discipline of asset allocation. That's what's going on now, these rotations in the stock market. We've seen money being pulled out. You're seeing the Nasdaq's down 40% compared to the S&P and the Dow, but those were the stocks that went up 300%. The Dow wouldn't go up 300%. And so it's correlated to how much did you make and were you astute enough to pull the money out over periods of time instead of saying, well, I'll just keep buying more and dollar cost average out. Well, now you're down 40%. Netflix is down, you said on the last episode, 50%, 70% off of its highs. The business models change. There's no dividends while I'm waiting. They're losing subscriptions. So somebody's telling you something. That's a falling knife. What do I do with what I have? Do I keep it? Do I buy more? I have to make a decision. And holding a stock is the same buying the stock decision that people forget, because you're making a decision at 140, I still want to own the stock. And it may not be the right time. Go ahead.
Yeah, one of the things that I hear when I try and explain this to clients and non-clients alike is, well, I'm up 50, 60, 70% in this stock. If I sell now and I'm not in a tax advantaged account, then I have to pay taxes on it. And I cannot tell you the number of stories that I could give you right now of the people who lost a whole lot more than they would have paid in taxes because they just kept holding on. Remember, paying taxes means that you made money. And so far, they don't have 100% tax. So it can be a very good idea to sell when it's appropriate.
You know the lines. You never go broke taking a profit.
That's right.
And then we used to always say to clients, never let commissions and capital gain taxes get in the way of taking your profits, because you never know when those profits are going to disappear. My biggest story was Cisco. You and I are not in a position to want to give our clients all their profit back after 3 or 4 years of success. And so that's pruning the tree along the way. It's the asset allocation. It's resuming, hitting resume on your cruise control. And so you won't go broke ever taking profits. You don't want to let taxes get in the way, because you never know when the tide's going to turn.
Right. And I think of that. I think of the idea of thinking that things work forever. Like the old 60-40 portfolio, that's something we hadn't talked about talking about, but that old idea that 40% of your portfolio should be in bonds or fixed income, and the 60% should be in equities. Well, certainly over the past really 5 years, that has not worked at all. And there are still financial advisors, there's still people on YouTube, there's still lots of people out there saying that this is the way that you should put together your portfolio. The market has changed, and with in technology you have innovation and things change. It used to be that this thing here on my desk, right? This thing would have filled up an entire huge warehouse. The power that's in this phone. Now it's in this little phone that I carry around in my pocket. Things change in technology. Things also, there's innovations in the financial industry as well, and they're not evil. They're meant to help you. They can be used for evil, and they can be used if not used properly, if not understood, then they can hurt your portfolio. But they're really made for investors to be able to manage their risk based on where they are in their lives. If they need income, if they don't need income, if they've got a 10-year time horizon or a 2-year or a 6-month time horizon. I think that's important to mention.
You mentioned a couple things here. So all things end badly, otherwise they wouldn't end. So the trends change, and sometimes they don't come back. You can ask the horse and buggy business. Now we're talking about electric cars, and maybe the gas engine business is going to go away. And, the computer mainframes and the deck writing computers are now, like you said, it's iPads and tablets and, a phone that fits in your pocket. So things change. And so you've got to modernize your portfolio and have that discipline. But again, it's a risk management side to this, is how much of your money belongs in that bucket. The other piece you mentioned was the 60-40. And so what people may not understand, my listener may not realize, is when you and I started I was in the later 80s, 87, you could have bought a AAA rated municipal bond paying over 7%, what they deem to be triple tax-free, state, city, federal tax. So a municipal bond is issued by local government municipalities, i.e. why it's called a municipal bond. And because of that, they get a tax-exempt status. And so the high net worth individual could take zero stock market risk, get themselves a 7% after-tax rate of return, which at their tax bracket could be worth between 12 and 14%, depending on what the tax rates were and their income levels were. And so they had no reason to take a risk on IBM, AT&T, Xerox, Apple, and anything else that existed. And so what happened is the trend eventually, as rates dropped over the next 30 years, and I'm sure before I got in the business, municipal bonds were maybe 10%. Right? Eventually, it went down to where it was 2 or 3%. So as rates went down, the economies got better. There's this whole debate in the real estate world of like, oh, rates aren't that bad right now, compared to the history. Yeah, but my house was $80,000 and now it's $800,000. Like, it's not the same environment. You can't justify to me paying a 7% mortgage on an $800,000 house was the same as paying 15% on an $80,000 house. It's not the same correlation. And my income is very, very different, in that regard. So from the fixed income side, as you were saying, the 60-40 paradigm, and we talked about this on the very first show you were on, is bonds are defensive, they're not necessarily safe. And so when you put somebody, let's just say they were retired, they're 70 years of age, and 60% of their money was in equities and 40% of the money was in fixed income, or even the reverse. They were heavier in fixed income. The flight to safety, when the markets drop like they've been dropping in this environment, there has been no flight to safety because the catalyst of this market has been a spike and rise in interest rates. And let's put a stamp on that and let's put a so what on that. 3 months ago, you could have bought a 10-year treasury, government issued, highest credit rating out there, a 10-year treasury bond for a whopping 0.75% interest. That means on $100,000, you're making $750 of interest. You're not even making 1%. As of now, we're recording on June 15th. This will be out probably in about 10 days or so. But as of today, the 10-year treasury was 3.4%. And 2 weeks ago, it was 3%. So let's just use 3% for the math. If I put $1 million in something at 0.75 and the rates now go to 3%, the value of my bond has to reflect the current interest rate market because you're not going to buy it from me unless you can get 3% on your money. So I've got to drop the price to make it that 0.75% coupon match 3%, which means I'm getting 25 cents on the dollar. I've just taken a 75% loss. That's a lot worse than the S&P and the Dow right now, isn't it? So the flight to safety and the people who were putting their money in fixed income to stay out of stocks harm walked right into their own buzzsaw. And so individual bond ownership is the only way that you can circumvent that, but at a cost because the next 9.5 years, you have to hold on to it to get your money redeemed back. But if you need your money in the next 9.5 years since you bought it, you're going to take a bath.
Right.
Right.
And by the way, during that time, you're only going to make $750.
Oh,
and meanwhile, inflation is going up at potentially double-digit rates.
So the so-called inflation they want to tell you about.
Yeah, exactly. Right. This
is
a whole different story.
Here's another what Wall Street doesn't want you to know. So the CPI, the Consumer Price Index, doesn't count energy and oil prices. And the gas pumps have gone up 250% in the last 2 years.
Right. You almost said it there. You almost said instead of consumer price index, you almost said the confusion price index.
Confusion price. There you go. I like yours better. We'll make fun of it. So the confusion price index. Now, the kick in the ass on that, again, what Wall Street doesn't want you to know what the government was doing. This is going to go back to Obama. Okay. So for the retired audience out there, your Social Security checks only get an increase based upon 50% of the confusion price index, the CPI. So if the CPI is 4%, you're going to get a 2% raise. Well, guess what happened during a lot of the tenure under the Obama administration? Year after year, we kept reporting there's no inflation, there's no CPI. And so the seniors were denied year after year for several years in a row, no increase to their checks because supposedly inflation didn't exist. Well, guess what I noticed? And I'm sure you noticed because you've had how many kids?
6 kids.
6 kids to my 3. So I bet you went through a lot of cereal and ice cream and Pop-Tarts. And so your 16-ounce box of cereal all of a sudden was 14 ounces. Your half gallon of ice cream, which I don't know how many ounces, what is that, 128, 64 ounces? So instead of getting 64 ounces, all of a sudden you were getting 57 ounces. The cartons were shrinking or the bags were the same, but there was less volume in there. And so the cost per unit was going up, but General Mills and all the food companies were like, we didn't raise our prices. There's no inflation. Well, you didn't raise your price per se for that box, but you gave me less, which means I got to buy it more frequently. So my unit cost did go up. My consumption price for that bowl of cereal went up. Don't tell me there's no inflation. But it was being suppressed and nobody talks about it because it's the confusion price index. Again, we got tons of...
I, for one, was very upset about the ice cream getting smaller. That was a real problem.
I'm used to eating a half gallon at a sitting. Yeah. Now I got to get up and get a second container. Oh, too funny.
Well, we were going to talk about the dead cat bounce too. I think it's important because we've seen a lot of that in the past 12 months where the price will come down and then, oh, it's over, because we were conditioned to that a little bit over the past many, many years, but especially like in March of 2020 when the market completely fell apart over that 1 month and then bounced back, and there was almost no looking back. And here during this time period, we've seen a lot of bounce. Oh, it's okay, it's okay. No, it's not okay. And then, oh, it's okay, it's okay. No, it's not okay. And I keep hearing, oh, now's the time to buy. Now's the time to buy. And that's the idea of catching that falling knife. But really what's happening is and apologies to all the cat lovers out there. This is just a phrase. I love cats. I love dogs as well. But they call it even a dead cat bounces when you drop it, right? And that's kind of what we've been seeing here of late. And there's lots of reasons for that. I don't know if we have time to get into some of those, but
Well, I'll draw it into the last episode where we talked about the distribution channel again. And as you alluded to, is we keep seeing people saying, oh, it's bouncing, and it again, back to that dollar cost average, or pick up some shares here. And then 2 days later, it drops another 3%. And so the dead cat bounce is the markets are legging down in waves. Don't forget that there's institutional buying in there, and there's a lot of those black boxes, which are all algorithmic, easy for me not to say, algorithmic, that it's just computer automated trading. And so it gets to a certain point, they may pick up a few shares, and then they hit the sell button again, and they'll try and capture a percent or two in the bounce, but they really are intending to just keep selling. And so the dead cat bounce ties back to the distribution channel. Is the average consumer is using this, oh, it's a good time to buy, oh look, I missed it, it just bounced, I could have bought it yesterday for 40, today it's 42. And now they're like kicking themselves, and then they'll pay 43 the next day, and then 2 days later it's at 35. Because the sell-off just continued, and a dead cat bounce suckered them back in. And so the distribution channel that we're talking about here is the street needs the fool to buy what they're selling. And as we said earlier, when somebody yells fire, who's going to be the first one out the doors? Well, Wall Street inherently is never going to tell you to sell, John Browning, because there's nobody to buy if they say to sell. So if they say, we think this market's going to go down for the next 5 years, everybody should get out and go to cash. The economy in Wall Street as we know it would vanish. Everybody would be broke. So there is no inherent sell that's ever going to come your way, which you and I go back to why you need a discipline, you need a financial plan, you need to know your risk tolerance, you need to have an exit strategy, you need to do your resume, and have a discipline in managing your assets. Because if it's down 30%, John and I don't know if it's going back to where it was or it's going to drop another 30%. Now, John will tell you, you go on a desert island for 5 years, I bet it's higher when you come back. I'd say that might be a good bet, historically, or 10 years. But tell me in the next 3 months, 6 months, 9 months, and every day when you're reading the newspapers and you're watching the TV shows and everybody's just drumming up, again, here's a fun fact that was in today's newspaper, that Coinbase or one of those crypto exchanges announced they're laying off 1,100 people yesterday. Crypto's fallen so hard, so fast, and we touched on this on the last show about the distribution channel and using, Bitcoin, and feeding out to the public market when it was already at massive highs. All of a sudden, they're laying off 1,100 people. There's a crypto winter coming for those who are Game of Thrones fans.
Well, I think there's a few points in there, right? It's you just you do not know. I don't care how smart you are, and I have friends who are some of the smartest people I've ever met. I have seen extremely intelligent investors, famous investors, that have thought that they could time the market, and because they were right once, maybe they were even right twice. The problem is you have to be right getting out and you have to be right getting back in. So that's twice right there. I have yet to meet anybody who truthfully can say they've been right 3 times in a row, calling the exact bottom, the exact top, exactly when to get in and out. So the idea is not to time the market, but it's to have a discipline. a portfolio management discipline that consistently works over time.
You and I say it often, I'm going to jump on this, is you and I can't control the market. We can't guarantee people performance. All we can do is put them in a position to succeed because we've got 65 years of experience. We know where the warning zones are. We know where the damage can be. And we're here to protect our clients from making those mistakes. But neither you nor I nor anybody out there is going to know consistently, day in and day out, what the markets are going to do. We know in theory, over time, it goes up. There are hiccups. There's bubbles, there's collapses, there's recessions, there's depressions, whatever it might be along the way. But if you look at the trend lines and the historical performances and take 20-year history, 30-year history, 100-year history, they go up. They go up. Just like real estate. They don't make any more of it. So everybody says real estate's always a safe investment. Well, yeah, I need a place to live. So in theory, it's safe. But from an investment standpoint, separate conversation, separate show. But again, you just have to know a strategy and not just shoot from the hip on something like this.
And follow that strategy even when it gets a little tough to follow.
Well, exactly the point is you and I are paid not necessarily to put the clients in the market. We're paid when they want to get out, and we got to hold their hand and keep them from jumping. The dead cat bounce correlates to people jumping out of windows, and that it'll still bounce, right? So when the markets crashed in 29 and 87, unfortunately, a lot of people got hurt financially and jumped out of windows. They jumped out of buildings. And so, even that person's going to bounce when they hit the ground. So the discipline takes away the emotion. So when you and I have educated our clients properly, and now the emotion is kicking in, we can go back to the foundation and say, you know what, John, remember when I told you this, that, and the other thing? And remember the quilt graph that we looked at? Where are we now, John? Remember we had that conversation? Remember we said we're going to get to this point? So the hand-holding is where we really earn our money with clients, not just putting a portfolio together. But it's setting expectations. If you don't set the client's expectations, that's what the relationship is about with your financial advisor. Again, anybody could be right once or twice. And just to put a message on it, only 2% of the influence to your portfolio performance comes from market timing. You'll be lucky once, you might be lucky twice. You're not going to be lucky for 40 years. True? Anything else before we start to wrap up what Wall Street doesn't want you to know here on Ask the Planman? Any other points we wanted to cover?
I think we've covered quite a bit and probably overwhelmed a few people, but we can always reach out to us and get some individual advice, and we're happy to provide that value, right?
Mike Tyson said, everybody has a plan till they get punched in the face. Is your financial plan, your asset allocation, your asset management punch in the face proof, right? That's what we want to say. Are you punched in the face proof so that you're not panicking, you're not making emotional decisions, you have a logical understanding of what you're doing, and yeah, you may be dollar cost averaging, and that might be what John tells you to do or what to do with your assets, but don't knee jerk, don't be emotional. Have a strategy, understand where we are in the markets right now. It might be too late to get out. It still might be too early to get out. I don't know. And John doesn't know. But it depends on your risk, your timelines. If you're 87 years of age and you needed all that money, you shouldn't have been in that game, right? Don't walk in the casino if you're not prepared to lose the money. And so we're not here to put people's money at a risk to lose it all. Stocks aren't necessarily all going to go to zero. A mutual fund's not going to go to zero. A individual stock could go to zero, right? My A11 stock at, that was highly rated, little old lady stock we talked about in the first episode, it went bankrupt, okay? Enron went bankrupt. GE almost went bankrupt. So the biggest of blue chip stocks, they may have their day and it won't be a good day. So let me thank my guest. Go ahead, John. I'm sorry. Any closing comment?
Well, to that point, right, is if the market does, well, let's just say the market does go to zero, then capitalism has died and we have a lot bigger things to worry about. So if you're diversified, if you have a plan, if you have it properly allocated to your needs and your investment horizons,
it's a great point. if the market truly ever went to zero, our lives as we know it, it wouldn't matter what was going on, because we're either speaking Chinese or Russian, or space aliens have wiped us out, or something, something insane, that society as we know it. So yeah, the markets don't go to zero, folks. Individual positions can. Again, know what you own, understand your portfolio, make sure you do what John and I call overlap studies. Just because you're in a mutual fund and have 5 different mutual funds doesn't mean you're diversified. If all 5 mutual funds are buying the same sector of stocks, tech, then you just have 5 times the exposure to tech that you probably need or should have. That's not diversification. You need non-correlated assets, which you can speak to your advisor, speak to John about what all that means, and put that into place and stifle the risk. Stifle. You want to stifle the risk by being diversified. The bigger the risk, the bigger the concentration. You spread your concentration down. What's the rule of thumb you try and follow when you buy individual stocks? 4%, right? No more than 4%.
No more than, well, generally I will allow them in most portfolios to get up to 5, and then I'm looking to trim.
There you go. But you're not going to jump in at a 7% position from day one.
I'm not even going to jump in at a 4%. I'm going to jump in at a 1 or 2% position and then dollar cost average in. Yeah.
Right. So the rule of thumb, folks, is that no more than 4% of your money should be in any one stock. So somebody who's got 50% of their money in Apple right now has made a fortune in Apple, but any purist is going to go, woo, you got way too much exposure in Apple. You're looking for the fast money. It's not necessarily the wise or the smart money. And so this goes back to your discipline, your asset allocation, buying things that are out of favor, buying low, waiting and be patient for it to come back. And that's where you and I separate ourselves and make clients more money in the long run and keep them from losing money. It's not what you make, it's what you keep. You got to keep it in the downturn, right? One more lesson for everybody, and we're going to go. If you made $1, if you invested $1 and now you lose 50%, you have 50 cents. You now make a 50% return. Are you even, John? You're only at 75%, right? So know your numbers when you say the average return. Well, if it made 50% one year and lost 50% one year and then made 50% back, you're not even. You're not even close, okay? Historical rate of returns on stocks are between 10 and 12%. If you lose 50% of your money in this market right now, in theory, it's going to take you 5, 7, 10 years just to get back to even. We don't want you losing 50%. You need a diversified portfolio. You need to have assets that hedge. You need uncorrelated assets. This is what Wall Street may not be telling you. This is what you need to be doing in your portfolio. If you're doing it on your own, I guarantee you're not doing this stuff. Most people don't, unless they're a retired professional like you or I, hopefully someday will be. But the bottom line, the message is find John, Guardian Rock Wealth Management. You can hit him up there. His book is Build a Life, Not Just a Portfolio. Make sure we plug your book. You can always reach him through asktheplanman.com. Text us, email us, call us, like, subscribe. If you need advice, always get it right. Come ask the Plan Man. Make sure your plan is what, John? Fun. I muff it up every time. Punch in the face proof.
Punch in the face proof. That's right. Yep.
Face punched proof. Face punch proof. Thank you, everybody, for listening. We'll see you next time on Ask the Plan Man. Hit me up, Bruce at asktheplanman.com. Give us a call at 1-844-PLAN-MAN. Like, subscribe. My producer will be putting the pings in there. John, thanks for joining us for this 2-part conversation of what Wall Street doesn't want you to know, and we hope to have you back again soon. Thanks, everyone.
When you need some advice, never sacrifice, always get it right. Ask the Plan Man. Finance, insurance, and more.